Hello and a warm welcome to Personal Finance. I'm Gugulethu Cele. Now tonight we're speaking to Standard Bank Economist Siphamandla Mkhwanazi. Now that's to paint a picture for us with regard to some of the trends we're seeing with regard to how consumers are managing to decrease the levels of indebtedness when purchasing homes for the first time. So some good news certainly coming through. Spa, thank you so much for your time this evening.
Thank you for having me.
Let's pick up on this particular trend, which certainly got my attention, because so often we know that purchasing a home is one of the most important asset purchases you'll probably make, especially if it's the first time. But this trend where South African consumers are actually saving a lot more for their deposits, is this something aligned to the economic cycle that we're in the country at the moment?
Yeah, no, definitely. So there are two elements to that. The first one is that there has been an improvement in consumer affordability, and that is because income over the past 10 years has grown faster than house prices. That's the first thing. And the second thing is that banks over the past 10 years have tried to tighten their lending standards. So they've constricted credit to first-time buyers, and that has caused consumers to borrow less per rand of income for over the past 10 years.
Mm-hmm. You say that levels of income have certainly increased. Is this for a particular income bracket? And if so, could you divulge, the kind of people that you spoke to find these studies further?
No, we see that across all income levels. We conducted a study on a median first-time buyer, and the median first-time buyer currently earns around 30,000 rands a month. That's a median first-time buyer. But
combined income or as an individual?
Combined income.
Oh,
combined
okay.
income. But income growth has been across all levels of income, and we see that not just with first-time buyers. We see that with every South African, because income over the past 10 years has grown faster than inflation for over the past 10 years. So it's consistent with what we see at an aggregate level. It's not just for first-time buyers.
On average, if we take a look at the kind of deposit that banks want for a purchase of a home, what kind of figures are we looking at here? Is it 10%, 15%? And if so, how long does it take for consumers to save up for these?
So the first thing to understand is that your deposit will depend on your individual circumstances, will depend on your income, will depend on your risk profile. So that's the first thing. The second thing is that it also depends on where we are in terms of a cycle, in terms of business cycle with our economy, in terms of the business cycle. So what we see is that during the downward phases of the business cycle, as is the case currently, and during the hiking phases of interest rate, as it is currently again, we see that banks tend to require more and more deposits from consumers. So consumers are being called upon to raise bigger and bigger deposits when the economy is in a slow turn, is in a slowing down phase, and when interest rates are rising. So currently we see that in the first quarter of 2016, to be specific, consumers have had to raise 1.7 months worth of disposable income. So it means that if you were to buy your first home in the first quarter, that is, you would have to raise 1.7 months worth of disposable income. So that means that if you earn 30,000 rands a month, so you will need something about 45,000 as a deposit. And again, like I said, that depends on your personal circumstances. And what we see is that it does take, if you look at 1.7, it does look like a low number. And if you were to compare it to the global financial crisis in 2008, 2009, it would have required you to raise 3.2 months worth of disposable income. Now, if you want to understand how long how long it takes to raise that kind of cash, you will have then to look at the spending behavior of the first-time buyer. And we did that in our study, and we found that given their spending behavior currently, it would take about 19 months to raise a deposit to fund your first home. Now, compared to the height of the global financial crisis in 2009, it would have taken something like 39 months. And if we were to look at where the trend started to take up, that would be in the third quarter of 2013, it would have taken just 2 months. So that is driven by banks wanting to, between the global financial crisis and the third quarter of 2013, banks wanted to give out credit, so they were more willing. They wanted to take more risks, and now that trend has taken an opposite turn because the economy has slipped into a downward phase of the business cycle.
Before we delve a little bit deeper into the economy and how it does impact our pockets, I want to stay with that trend with regard to the 19 months that it takes to save up for this deposit. Again, like you say, it clearly shows us the spending habits of South Africans, because if you probably have a vehicle first before you purchase a home, so a lot more financial responsibilities. But that number can certainly improve, can't it?
It
19 to perhaps 10 months?
It definitely can improve. What we see is that a lot of South Africans are spending a lot of money on non-essential goods. So if one were to cut on such spending, it would definitely improve. What we see is a very low saving capacity of first-time buyers currently, and that definitely can improve. A median first-time buyer, like I said, ends up about 30,000 rand, and our calculations show that they can save up to about 10%, and that's low. And if you wanted to buy a house, you definitely need something more than that to raise a deposit, because you will be required to pay a deposit given where the economy is.
So true. Another reminder why we need to stop our extravagances on our shoes and fancy dinners. But if we do take a look at the current environment with regard to interest rates, we did see very sharp interest rate hikes at the beginning of this year, which caused some nervousness, including with individuals like myself when it comes to the bond repayment. But given the latest meeting from the MPC keeping rates fairly stable for the moment, does this provide us with a moment of reprieve where perhaps for those who do want to save up on a bigger deposit for their home, they can do so, and for those who already have a bond, perhaps catch up on some payments and try to get ahead?
Yes, definitely. Yeah, we did see that reprieve, and the Reserve Bank did say it's entered into a pause mode when it comes to interest rate, and there is a likelihood that the next turn will be the next round will be cutting off the rates, but that is likely to happen in mid 2017 or so. So consumers, as they have done over the past 10 years, interest rates have been low in the past 10 years compared to historical trends, and we saw consumers decrease, deleveraging on their debt. We saw consumers borrowing less and less despite low interest rates, which is a good trend for consumers, a good trend for affordability. And such a pause from the Reserve Bank provides such an opportunity for consumers again to catch up on their repayments and reduce on debt, so that they free up some of their cash flows and spend on other goods.
For those who are able to pass the affordability assessments and qualify for bonds at the moment, what trends are you seeing? Are they choosing to fix their interest rates or leaving them variable and adjusting to the cycle as it happens?
Right. We haven't done such a study, but given that the next round of dealing with the interest rate, it's likely to be to cut the interest rates. It would be beneficial for consumers to want to keep it flexible for now, because the next turn might be a cut. So we want to take advantage of those cuts.
Coming back to the study and what we've also obviously found, I want us to perhaps draw a trend that we've obviously seen. You've alluded to what we saw during the financial crisis and even years before that, but are South African consumers in a good position right now to really get their finances in order compared to the economic cycle that South Africa's previously been in a few years back? Yes,
definitely. What we see with the current cycle is that consumers are in a much better position than they were in the previous cycle. The most recent one was in 2008, 2009, as you just alluded to. Like I said, even though the trend is increasing when it comes to raising those deposits, even though the trend is increasing, it's still far below where it was in 2008, 2009. So they are in a better position. And again, if we were to look at the number of insolvencies currently compared to 2008, 2009, we are consumers in a much better position compared to the last downward phases of the business cycle. So we are seeing a bit of the resilience from a consumer given, and I think that it's because of the historically low interest rates coming off from a low base, even though they're increasing, but it's coming off from a very low base, and consumers took advantage of that and borrowed less given the low interest rate.
Exactly. Sounds like an opportunity for us to take advantage of.
Sounds like an opportunity, yes.
Yeah. Well, Siphamandla, we've certainly said quite a bit, but let's get a quick recap now on some of the key takeaway points from tonight's discussion. Well, Spire, for those viewers who caught the tail end of tonight's discussion, what are the key considerations that they really should bear in mind given the current economic cycle and really taking advantage of saving more aggressively for home loan purchases?
Yeah. So what we're seeing is that consumers have borrowed less per rand of earnings over the past 10 years, and that is good for the consumer. It's good for the consumer because given that the interest rates are in a hiking cycle, there is a less risk for them to be caught in defaults, the interest rates are likely to likely to take a cutting trend from now on, and that gives consumers an opportunity, gives them a reprieve to catch up on those defaults, if there were defaults, and spend on other goods that will take the economy out of this slump.
Exactly. Thank you so much for your time today and giving us some sound views with regard to the economic cycle and how it impacts on consumers looking to purchase their homes. And it seems as though everything is working in our favor so far as South African consumers. So take advantage of the cycle that we're currently in economically. Well, that's how we wrap up our view of personal finance this evening. A big thank you once more to our guest, Siphamandla Mkhwanazi, who's an economist at Standard Bank. Well, do feel free to share your views and comments with us. You can tweet us at CNBC Africa using the hashtag Finance410, or alternatively send your tweets to me at Gugulethu and share your views as to how best you're preparing to save for that big asset purchase. But until next time though, we wish you a wonderful evening.